All right, guys, we'll go ahead and get started in this room. Hi, I'm Ansel, and I'm on the schedule to do Bitcoin Maximalism. I was unaware of that until 2 days ago, so I threw something together for Bitcoin Maximalism, but I have a prepared presentation on the decline of the dollar, the terminal phase of the dollar. So hopefully you guys enjoy that. But first, let's hit Bitcoin Maximalism. I did write the Bitcoin dictionary. It's 180 terms of Bitcoin jargon, and each entry is kind of like a little Wikipedia article. So I'm going to read what Bitcoin Maximalism is. Number one, originally a pejorative intended to mean an unfounded belief in Bitcoin's superiority, characterized by closed-mindedness, aggressive debate style, and public confrontation. Number two, the general understanding of the technological, social, and monetary properties of Bitcoin and how they explain the observable dominance of Bitcoin relative to altcoins. In the little discussion I have here, it's the term Bitcoin Maximalism was coined by the founder of Ethereum, Vitalik Buterin, to poison the well against Bitcoin arguments. The label was quickly reappropriated by Bitcoiners to emphasize the economic and technical theory behind this technology. Bitcoin maximalists typically have an appreciation for sound money and markets. They are passionate about free speech, but have little patience for willful ignorance and con men intentionally misleading investors. So the bottom line here is that Bitcoin maximalists, they know why Bitcoin is revolutionary. Okay, it's a distributed consensus, a decentralized network, and decentralization is good for one thing, and that's censorship resistance. So when you hear other features from other altcoins, oh, smart contracts, blockchain, decentralize all the things, that is not what decentralization is for. It is just strictly for censorship resistance. Everything else can be done better with a centralized database or network. Decentralization is not an inherent good. It's not a magic bullet that makes something better than a centralized grid, which is what you would think if you listen to a lot of altcoiners out there. Decentralization is slow, expensive, and inefficient because you have to duplicate everything on every node. You have to duplicate all calculation or verification, transmission of transactions, all of these things. So centralization is slow, expensive, and inefficient. If you want censorship resistance, which is the only thing that decentralization is good for, you have Bitcoin. Everything else can be built on top of Bitcoin in a centralized layer 2 or like a federated layer 2 like Liquid or something like that. So you're never going to beat Bitcoin on the censorship resistant piece. Now I have some DeFi here as an example. They want to distribute financial access or make financial access open to the world. That is an outcomes-based argument because they think that's going to be beneficial. But most of the time, people that are good with money already have access to the banking system and things like that. So if you open up financial access, you're usually going to open it up to people that are less good with money. And it's like giving money to a 5-year-old, right? If you give $100 to a 5-year-old, they're probably going to lose it, tear it, waste it on candy or something like that. So usually what happens is if you give money to people that are bad with money, they're going to waste it, they're going to be scammed. They're not going to be able to evaluate a legitimate project from an illegitimate project. Does that, what they're saying, check out? Should I invest in that? Yes or no? That's why there's so many scams in the altcoin space, because people can't evaluate these investment opportunities. Middlemen are not trusted third parties. So in DeFi in particular, they like to say, the banks kind of centralize access to these things. But middlemen are good for the most part. Bitcoin is against trusted third parties, which are rent seekers. These are parties that don't add anything productive, but they take a fee. So the classic economics example is a chain on a river. So go back a couple hundred years, and somebody that owns some property on a river, they put a chain across the river and they charge them toll. That toll, that chain is unproductive, completely unproductive, and the fee is a complete cost. So that is rent seeking, and that's what trusted third parties, that's what Bitcoin is against. They're against central banks in control of the definition of money. But middlemen in general are not bad. Bankers as middlemen are not bad. This is the division of labor. they have a specialty to distribute capital in the economy, right? So they have a specialty, and you pay them for their specialty. So Bitcoin, now circling back to Bitcoin, is Bitcoin won't replace the banks. A lot of people say, oh, but Bitcoin is to, you're trying to get rid of banks, that's why you want Bitcoin. Bitcoin is to replace central banks. But Bitcoin will fix the banks by fixing the money, okay? And that's going to bring me into my presentation. Okay. Just hit the space bar. Okay, so the terminal phase of the dollar system. Go ahead. So thank you for that introduction. It's great. I guess I'm an economist, the Bitcoin guru type. I am a deflationist. I think I'm the only deflationist in Bitcoin, other than perhaps Kent here that writes on my blog with me. Jeff Booth is another famous deflationist in Bitcoin, but he comes from the technology side. So he thinks that exponential technology is going to drive costs down. I think that's actually a subcomponent of monetary inflation, and I'll try to show that here. But Bitcoin Markets is my brand. That's what I do. I'm also with Bitcoin Magazine doing FedWatch and op-ed stuff. So, slide. This is what this presentation would cover. Fiat versus credit-based money, a debt burden or diminishing marginal returns on debt, a growth environment, talking about that, interest rates, asset price inflation, what a dollar decline will look like, and how Bitcoin fits into that. Slide. So I think we all know that there's something wrong with the monetary system, that the end of the dollar kind of era is at hand. But I would caveat that with saying it's the end of the dollar as we know it. The dollar has iterated or morphed several times in its history. First it was silver standard, then a bimetallic standard, then a gold standard, then a debased gold standard, then Bretton Woods, and then now we have credit-based money after the Nixon shock. So about every 30 years or so, we go through a iteration of the dollar. And it's logical to think that the dollar could iterate again. And I think it's going to be backed by Bitcoin. Slide. But you hear a lot out there about inflation. Gold bugs, Bitcoiners now have really caught on to this inflation narrative. But the end of the dollar system is not going to be inflationary. And I'm going to show you why. Slide. So all fiat currencies end in hyperinflation. That's the pushback, that the typical pushback I get from Bitcoiners or gold bugs. Yeah, I'm willing to grant that. Usually there's only a handful or maybe a dozen or two major currencies that have ended in hyperinflation. Most of them end in just a high inflation period and then they're changed to something else. Look at Argentina or Brazil. They'll suffer 100% inflation within a 5-year span, and then they change their money. So fiat currencies don't always end in hyperinflation, but I'm willing to grant that. Slide. But the US dollar is not a fiat currency. The US dollar is a global credit-based currency, and that distinction is extremely important. Slide. So, who here knows Mises? Okay, Mises is the godfather of the Austrian School of Economics. They have a website, Mises.org, for the Austrian school. And off their wiki, this is their definition of fiat money. Often called paper money, fiat money is, in a wider sense, any money declared to be legal tender by government fiat. In a narrower sense, fiat money is an intrinsically useless good declared to be legal tender by government fiat. All modern paper currencies are fiat money. I have many issues with this. I'm an Austrian at heart, but I have many issues with this. First off, all modern currencies are not paper. All modern currencies are 99% digital. So that's, often called paper money, and all modern currencies are, paper currencies are fiat. And then let's just look at the fiat itself, or let's look at the paper itself. So for the US dollar, there's $1.4 trillion in paper currency in the world. Of that, 1.1 trillion is $100 bills. Out of that, 2/3 is held outside the United States. So if you do the math, more than half of all paper dollars are held outside the United States. It's held outside of the government fiat. It's held outside of this jurisdiction that is imposing the fiat. And so how could they say that the paper, even the paper version of the dollar, how could they say that's due to government fiat? Okay, so fiat money versus credit. So fiat money I think of as being one-sided. When they print when you print fiat money, you get, like think of a balance sheet. When you print fiat money, you get more assets, but nothing happens on the other side. That's why there's more money chasing the same amount of goods, and you get price increases. But with credit-based money, it's two-sided. When you print credit-based money, it's in the process of a loan, and you have assets and liabilities. Okay, so that is two sides of the same money. Every dollar has an associated debt, dollar debt, and that gives it a natural limit. There's a natural limit to how much credit can be created, right? There's diminishing margin returns on debt, and we'll get to that in the next slide. But yeah, so there is a natural limit when you have credit-based money. That's why we haven't had runaway inflation for 50 years. So, this is just a quick visual slide. Slide, please. Just click through these. Keep going. Go. Okay, so obviously fiat money, and then but credit-based money, you have assets and the liability. So if I get $100,000 for a business loan, there's a $100,000 debt associated with that. So they printed that money, my assets, and there's a liability. But the bank also has an asset, which is the debt, and liabilities, which are my cash. Now the relationship here between all of these things is very important to understand, and it's very, I mean, I don't understand it fully, but it's not as simple as saying QE is money printing, we're going to get inflation. Okay. For example, I get the loan, but I lose my job. Now I can't service my debts, most likely. And so my liabilities, I might stop paying on my debt, and the price of their assets is going to go down, right? Because I'm not paying on that, it's impaired, it's a bad loan. So the value of their assets is going down, but their liability is still up. So now they have an imbalance. They have more liabilities than assets on the bank's balance sheet. And then the bank that lent them money is going to see that they're underwater, and it's going to go on and on and on. So there is a limit, and the limit is the amount of debt in the system. So US dollars are printed in the process of making a loan from the banks. Slide. Repayment on a loan is money destruction. And default is also money destruction. So money is created and destroyed in a credit-based system. That's also very important because the rate of change of that credit. So if there's $1 million created, but there's $1 million paid off, what is the net inflation or the net increase in money supply? It's zero. So you can still have money printing, but you also have repayment and default that destroys money. So it's kind of a battle between which is happening faster. Is the destruction happening faster, or is the printing happening faster? So good times. What happens in good times with credit-based money? So money is credit that ultimately is tied with growth. So in a good times, there's lots of opportunity. There's lots of new growth, new revenue, new businesses. Entrepreneurs can start new businesses, and it seems like you can't miss. Your revenue is increasing 10% every year, so you don't mind taking out new loans every year because you know you're going to be able to service those loans. So growth equals expanding credit equals inflation, and this leads to higher interest rates because you're willing to pay a little bit higher interest rate because you're doing so well. And there's competition in the economy, and everyone's doing well, and so everyone's bidding up interest rates. Slide. But there is the limit, and that is the diminishing marginal return on debt. And that is the benefit for every new dollar that is debt. How much growth do you get from it? This is a concept that we learned early on in economics. When you study economics, so the first bit of, like, the first piece of pizza has a certain value to you, the second piece has a diminishing, and the third piece is less, and then you're full. The fourth piece you don't want. But if you're forced to take that fourth piece and stuff it down your throat, you're going to have a negative value from it, right? So there's a diminishing margin return, and it can go negative. That's the same thing with debt. The first dollar of debt or the first unit of debt is going to be highly productive. It's going to be used in the economy in a highly productive way. Private sector is going to find the best use of that debt and use it to expand the economy. But by the 10th unit of debt that's added, the returns are diminishing. And eventually, when you have to start doing bailouts and all this government QE and all this stuff, you're adding more debt. It's actually becoming negative. And there is work out there by Lacey Hunt that says that the government productivity of debt right now is negative. So every dollar the government adds to their debt is actually bad. It actually takes away from GDP. But the private productivity debt is still positive. It's roughly about 25 cents for every dollar added to debt. We get growth on it. Slide. And this is just a chart from Lacey Hunt at Hoisington Capital. And you can see in 1950, it was very high, kind of flattish during the 70s, the great inflation. But then it's been downhill ever since. And we recently broke down to new lows. So the productivity of debt is declining rapidly. If we put Japan on here, they are about 10 cents or 11 cents. So they're down here. Europe is kind of in the middle. So, but everybody is going down. The entire world is going down like that because it's all credit-based money. So after good times, you get the saturation of debt, and that leads to lower growth. And lower growth is very important to think of it in net terms, like I talked about a minute ago. You'll hear things like, okay, this certain metric is not increasing as much as it was. It was 5%, but now it's 2%, but it's still positive, right? That's still inflation or whatever. But the problem is you have a time variable with this credit because when is the money repaid? In the future. So now, the money that's repaid right now was taken out in the past. So it was taken out with a higher growth rate, a higher inflation rate, more repayment of money is happening right now. If the growth rate now is lower, that means less new credit is being created. So the net is going to be near zero or zero. It could even be negative. The economy can't grow slightly. So we have the opposite of the good times. We have no growth, no credit expansion, no inflation. You do get periods of reflation, which you probably have heard that term. So that's where we had a crisis or a recession, and we had massive deflation or a spike of deflation. And then we had a kind of a bottom and a bounce. So we had a little bit more credit creation off the bottom, but then we have the next crisis, and it's going to deflate further. So kind of no credit expansion, you could say that there is some, but over a period of time, it's negative. And this is a problem specific with credit-based money. This wouldn't happen with sound money like gold-backed or Bitcoin-backed dollar because there is something to backstop any sort of deflationary spiral. So that's why in 2008 they were so scared of the system crashing to zero. Because remember the balance sheet, all money is credit. And what if all credit is defaulted on? The money supply can actually go to zero. And that would be extremely bad. But in a system where you have commodity money, you can't go to zero because that amount of money is what stops the bottom fall. Okay, exactly. Now, in this time of lower growth, you start getting a search for growth. I believe that this is kind of subconscious, maybe on a societal level or cultural level. People are starting to look for growth in a way because you're not getting as much productivity out of what you're doing. Maybe in the 80s you were getting 10% pay raises every year, and in the 90s you're getting 7%, and in the 2000s you're getting 4%, and now you're getting no pay raises. So you have this feeling that there is no growth. And so you start looking for things that can increase your productivity, and that's where I think technology comes in. During these periods, as growth is slowing down, people are searching for this answer, and technology is a good place to get a boost to your productivity. You also see things of malinvestment like Wall Street bets and altcoin scams. These are people that they don't know anything about what they're investing in. They just know that this is kind of a lottery ticket, and they might be able to get ahead and find the growth. Risks increase, and people get more desperate. This all leads to low interest rates. I recently wrote a piece for Bitcoin Magazine about the interest rate fallacy. This was a term coined by Milton Friedman back in 1968. And he identified that low interest rates are not stimulatory. They follow periods of tight money. And high interest rates follow periods of loose money. So low interest rates, or the interest rates in the economy, are dependent on the status of the money supply. Richard Werner came in about 5 years ago now and backed this up with more empirical evidence. He went back and looked at four major central banks for the last 50 years and looked at their rate of growth and the interest rates, the sort of growth of GDP to interest rates. And the only statistically significant relationship that he found was that interest rates follow a period of low growth. And so this makes sense. In our theory here that I'm outlining, tight money and low growth go together. And these two guys have identified that tight money and low growth lead to the same thing, which is low interest rates. So the bottom line is low interest rates are not stimulatory. If you hear people talking about, the Fed is keeping rates low to help stimulate borrowing, why aren't people borrowing? Why aren't the banks lending? So they think low rates are stimulatory, people will borrow, but then they are wondering why the banks aren't lending. Well, it's because it's not stimulatory. Low rates are a result of tight money. Responsible borrowing, it makes sense too. So remember, in our cycle here, we're talking about good times, saturation of debt, lower growth, low interest rates. Now in that environment, responsible people are not going to be taking out more debt. They're going to be paying down their debt, right? They're going to be trying to get out of debt. Maybe if you're a business owner, you're not going to hire those people, you're not going to expand your business, you're actually going to kind of tighten your belt a little bit. So responsible borrowers in a bad economy are not going to take out more debt. So that's why banks aren't lending. The people that still want the loans, they're going to, on average, they're going to be higher risk. They have higher risk investments. They want to, do a higher risk use of that debt, and so as a result, the banks are going to tighten the lending standards because riskier people are the ones wanting the loans. So lending standards tighten, interest rates go down, money supply contracts. And repayments and defaults outweigh new credit, and this is a deflationary pressure. So I wanted to talk about asset price inflation here. So low rates signal bad times, increasing risk, tight lending standards. In that situation, it's like you're going to have credit worthiness is going to be very important. And so if the lending standards are tightening, who's going to have access to new credit? It's going to be the most credit-worthy people in the economy. So large companies are going to be preferred over smaller or new ones. Rich people are going to be preferred over middle class or poor. Collateralized loans, like mortgages, are going to be preferred over uncollateralized. So this is a product of a deflationary environment. And I've tried to outline this in multiple places. But deflation can actually make some prices go up. Deflation can make the credit worthiness affect where new money is going. So those certain things, like large companies that are buying back their own stock, that's a good risk for the bank. It's a win-win. They know that if that's what the money's used for, they can lend them the money, they buy back their stock, and the price goes up. So that's a pretty low risk use of money. Rich people have connections and better uses of that capital. And of course the mortgages, the bank, like if I'm starting a business, I'm going to be a higher risk in a bad recessionary period. But my house is actually the collateral behind my mortgage. So they're willing to give me a loan for a house instead of a new business. So that is why it's a deflationary, low interest rate environment that squeezes the new credit into certain things. And that's why we see asset price inflation in this slide. This also impairs the trade between banks for the same reason. Credit worthiness is hugely important. Like I kind of showed on the visual of the balance sheets, if one bank's assets are impaired, then the people that lent them money they're going to be impaired too, and on and on. So there's a growing counterparty risk in the system, and fragility rises. Now I put on here chains of collateral. I don't know if we need to talk about that really, but it's you can think about rehypothecation. You might have heard that term. So who owns this certain loan? Who owns this mortgage-backed security? Who owns this treasury? Well, most likely 8 or 9 people, or banks have it on their balance sheet somewhere as an asset or liability. So it's very hard to understand who owns what. But in a bad economic time, in a deflationary period, those chains of collateral are going to shrink. So if money is credit and chains of collateral are, boosting the credit supply in the economy, and you start shrinking those chains of collateral, that's a deflationary pressure. So you can see that, like the Fed, their balance sheet is 9 trillion or whatever it is now. People say, oh, this is inflationary. But what you don't see is the 3 trillion or 300 trillion in chains of collateral that have now shrunk to 275. So the net total is deflationary. Slide. So the terminal phase of the dollar, I think, is what we see right now. We see high debt levels leading to lower productivity of debt, low growth, and a search for growth and malinvestment, low interest rates, with the interest rate fallacy, we talked about that, and a high-risk consolidation of credit access and asset price inflation, and we eventually get to rejection of counterparties. So all these chains of collateral shrink as the lending shrinks and shrinks. There's eventually going to be a rejection of counterparties. Slide. And this is a one-way ticket to depression. You can't get out of it. It's a self-reinforcing cycle down. The only way out of it is to change the money, to change the type of money, and so this problem is all based on credit-based money. And the answer is Bitcoin. Slide. So Bitcoin is a savings versus a debt vehicle, so it's completely flipping the script on the way the economy or the way people view money. And it'll be subtle. People don't obviously understand that money is debt, but they do in a subconscious way, and the way the economy is formed and the capital structure of the economy. So savings will outweigh debt. So there's also a time preference argument. So you guys might be familiar with time preference. High time preference is I'd rather have the money today versus in the future. So during when savings versus debt, when we're moving towards savings, that time preference is going to lengthen. It offers growth in a growth industry and at healthy rates of interest. So the interest rates in the Bitcoin space, they have recently come down a little bit, but it wasn't out of the usual to see something between 5 and 10% interest rates in the Bitcoin space. So I think that's an example of that there's lots of growth happening on Bitcoin. Slide. And that's it, guys. I would love to take any questions that you have. Yes.
How's your theory affected with the government basically borrowing the money, where it's not being created through the commercial bank service, where the government's borrowing the money from itself and then plugging that in through stimulus checks, through where the people are not really getting loans, it has to be repaid back. It's just the money's being created at the government level versus individual borrowers or the bank having an asset and liability. This is you're borrowing for yourself. So they're creating the money to pay back the loan as well as sending it out. Does that increase the amount of inflation that we may see? Or?
I don't believe so. The government actually borrows the money. They don't print it. They actually borrow from people, and every auction is oversubscribed. It's like over twice as many people bid on the debt than is actually printed. So the government borrows money from savings, and the reason why it distorts the economy is because it pulls savings to the present. So you're pulling forward all this consumption and all this spending where it should be in the future left, for investment stuff. So it's distortive, but it's not money printing. They actually borrow from people. Yes.
Correct me if I'm wrong, but this is more or less what Kathy Wood.
What's that?
This is more or less what Kathy Wood was talking about as a deflationist, where he sees this kind of deflationary cycle coming rather than an inflationary cycle.
I'm not super familiar with her stuff. I think she has a few quirks to her argument that I don't agree with. This is more in line with Jeff Schneider and the Eurodollar idea. I mean, anybody that's talking about credit-based money would be in line with this. Yeah.
So you mentioned the Eurodollar. Obviously, the Fed, there are banks, international banks, that are creating United States dollars by creating credit, and we can't control that. We can't stop that. What forces these international banks to make Bitcoin the reserve asset?
Okay, so the international banks. Well, that's true. So what he's saying, the Eurodollar is offshore dollar system or offshore dollar usage. And these banks, like let's say Bank in Hong Kong, can make a dollar-denominated loan, and that's printing money. Just like if Wells Fargo gives you a mortgage, that's money printed. So it's the same in Hong Kong or Singapore or Tokyo versus New York City or something. And they will run up against the same problem. And you can see that in China right now. They're having this credit bubble popping. So they have run up against that saturation of debt as well. They actually have twice as much debt to GDP as we do, if you include private debt. So they're coming up really hard against this, and I do think they're going to have a big crash over there in China. So they are beholden to the same laws of economics that we all are. Does that answer your question?
You're basically saying their only solution, their only remedy is they have to go to Bitcoin or gold, and they're not going to do gold. So
Yeah. The only solution I see is to change the type of money. You have to go back to a backed money, a sound money of some sort. So your choices are gold, silver, or Bitcoin, and I don't see gold or silver being in that conversation really at all, to be honest with you. Well, even though they do, most central banks around the world have a gold reserves still, so that could come into play. But I think most likely it will be Bitcoin.
You see, there are a couple different viewpoints in regards to governments using Bitcoin as a reserve asset. Do you see that playing out, and then emission Fiat on top of that, like it wasn't the gold standard, or do you see it purely just peer-to-peer? Because at some level, I mean, it's one of the beautiful things about Bitcoin is the access to just peer-to-peer transactions. Do you see Fiat being issued on top of that, used as like stored value, or do you see Bitcoin actually becoming a medium of exchange within the economy? Because I know there's obviously two schools of thought: store value Bitcoin and using it as something that's scarce, and then also it has this other element that a lot of these other ones like gold and silver don't have, where you can transmute
Anywhere in the world.
Anywhere in the world instantly. So it's a curious thought process of, is there going to be things issued off of this, or is it going to be purely the store of value with the addition?
Yeah. I wish I knew the exact answer.
Yeah.
It'll play out and make so much money. I think that Bitcoin will be the reserve asset, and most transactions will happen on either a decentralized layer 2, like Lightning Network, or Strike is a centralized layer 2. It's using a decentralized technology, but they themselves are centralized. And I think that's going to be mainly what we use is layer 2s built on top of Bitcoin. Now that does have a problem with fractional reserve. So we need to be careful with that, and I'm interested to see how that goes in the future. But at that point, we have a business cycle again, which is not a bad thing. A recession every 3 or 4 years, that's mild, and then growth again, that's a good thing. But not these periods of deflationary shock, low growth, can't get out of it, grind down to the bottom. And that's what we're in right now. Yes, sir.
I want to make sure I understand the deflationary concept that you're proposing. Is it due to the fact that high levels of debt then result in default, and then that results in the destruction of money causing the deflation? Is that the connection? I wasn't quite sure if I...
Yeah, so money, credit-based money is two-sided. It's like two sides of the same coin. you have the money and you have the associated debt. And if you get rid of that debt, you also get rid of that money. So if you default on that debt, that money disappears. And if you're having a hard time paying that debt, you know, the price or the value of that debt goes down. So the mark to market, if you mark to market these mortgage-backed securities or whatever, the value is going to go down. And that is actually deflation as well, because you're taking money out of the system. Yes?
Does that mean there can't be a debt jubilee like some people talk about? If
Correct.
there's a debt jubilee, that would just be a kind of catastrophe.
Correct.
Down.
Yep. They could have a debt jubilee in certain segments of the economy, like student loans or something. They could say those are all forgiven, but they would, that would have ramifications and consequences. Yeah.
And by default on the debt, you mean default restructure, right? So default and restructure would result in the destruction of that money. Whereas
Yeah.
if you default and then just hold that debt over your head, it would still be necessary.
Yeah. Yeah. Yes.
So I appreciate the presentation. I'm interested in your book, but I came into the room wanting to get a little bit more understanding of the Bitcoin maximalism. I'm fairly new to the space, and so maybe with your expertise, you speak to it. I get everything Bitcoin money related, but is that going to rule out NFTs? Is Pepsi not going to have NFTs? How are those two worlds not going to coexist?
Yeah, great question. NFTs, and I mean DeFi is another big one that people talk about and stuff. NFTs I see as I talk about this a lot, and even in the book I talk about the dual consensus problem. So whenever you are tokenizing something, whether it's a physical good or a digital good, you have a dual consensus. So that thing does not have to obey that token. If you get, think about if you tokenize your house, right? You have a token for your house. Well, what if your wallet gets hacked and that token now is with somebody in Russia or something? So you can't connect the thing with the token. So NFTs don't really even make sense. They're trading it's totally like little individual Ponzi's. You're just trying to find a greater fool to buy that token, that idea that it's tokenized to that thing. But there's nothing in the real world that is attaching that thing to the token. Does that make sense?
Yes.
The only other thing you could say is NFTs in game. So if you have a video game, I'm not a gamer or anything, but you can have weapons, swords or shields or armor or whatever you get in games, and they could all be tokens. Now these could have value. You can trade them. There is massive markets, billion-dollar markets for trading these types of things. And you could tokenize them, but it's reliant on that central party because that game developer can change the game and wipe out your NFT, the value of your NFT. So there is some usage for these things within a centralized playground sandbox.
All right, I want to put that. I'm going to say on Bitcoin maxis, so I'm not but we've already tokenized houses. That's what the recorder of deeds is. It holds the tokens for all of our houses.
Yep.
So we've had that system forever. So when you say we can't tokenize physical goods, I get your point that somebody could steal my title and hack their name, but of course that's why we have the court system to say either Steve gets his token back or maybe the Russian now owns my house. That's what the law is for.
Yep. But you're tokenizing the deed of the house in a centralized system.
Right.
So you're within this centralized playground of this system. And that's what gives it value, is the central party actually sticks that deed to that house. Without the central party, that's just a piece of paper. Then it's the stronger man takes the house or whatever it is, right? So it's all dependent on the central party.
So, but when you say there's no value to NFTs because you can't tie these things.
Right, because NFTs, NFTs, in my mind, like they're traded, that you see those artworks that are being sold, digital art that's being sold for hundreds of thousands of dollars. Those are predicated on that. This is a tradable token on a decentralized network without a third party, right? That is what I'm pushing back against. This idea that NFTs can be traded in a decentralized way on a decentralized network. They can be, but what you're trading is a Ponzi. You're not trading like the legitimate artwork. Because, I mean, you can go on and find that art, copy and paste it, and now you have that same art that the NFT is supposed to represent. So the NFT is really nothing special. Does that answer the question? Kind of. We'll talk a little bit later.
Yeah.
Okay.
So what about DeFi?
Well, I kind of touched on it here earlier, that I think that it's pretty dangerous to give access to a lot of people, because you are actually, the market has a way of sorting that out. And if you're really bad with money, you're going to have limited access, and there's a reason kind of why you have, it sounds so bad to say, but there's a reason why that is the case a lot of times. You are higher risk, and so you're going to get less access.
But you have Bitwise coming out with an EFT fund for Compound, for example. Is that a shit coin?
Oh, is Compound interoperability kind of token?
It's an Ethereum based, yeah.
Okay. Yeah, I think all the altcoins could be done better on a centralized system. And so there will be a centralized alternative for them in the future. And these tokens...
It just seems to me that these big funds wouldn't be getting involved with altcoins if they thought they was going to just crash. I just don't find that, I find that hard. I know that a lot of people here are Bitcoin maximalists. I get it, but why can't we have it all? Why can't we have everything? Why can't we have altcoins and Bitcoin coexisting in peace?
I mean, you can.
Yeah.
There's Venezuelan bolivars and dollars, right? There's all sorts of things that you can do. It's just a matter of what you think is the long term. And I'm not saying you can't benefit off of short-term price appreciation of your altcoin. But long term, we're talking what is going to change the system in the future. Are these great things like Ethereum world computer, is that ever going to happen? No, it's never going to happen. Democratizing finance, is that ever going to happen? No, that's never going to happen. But you could, in a short period of time, or short term, take advantage of these prices. Yeah. Thank you, guys.
Thank you.